John and Carla pulled into the same Toyota dealership on the same Saturday morning. Same job title, same income, both wanting the same gray Camry XSE. 3 hours later, they drove off in identical cars, but one of them just signed a contract that will cost $41,000 more over the next 12 years. And the worst part, the one who lost the money, genuinely believes they made the smarter choice. Their friends will agree. Their parents will agree. And when you run the actual numbers on a calculator, the gap is so large it almost feels like a math error. This is the lease versus buy debate, and almost every YouTube video, every dealership blog, not because the numbers are hard, because the numbers people skip are the ones that matter most. So today we run the real math, the boring math, the math your salesman does not want on a whiteboard. We take two identical drivers, two identical cars, two identical years, and we follow every single dollar for 12 straight years. Get a pen. Here's why this video exists. Almost every comparison you have seen on this topic focuses 3 years, 48 months, the length of one lease. Inside that small window, leasing genuinely looks cheaper. Lower monthly payment, no big down payment, new car smell every 36 months. That is the pitch. And in 2026, that pitch is everywhere. The average new car loan payment in America just hit $767 per month. The average new car lease payment sits at $613. That is a $154 gap. Every month, that leasing seems to win. Run that for 36 months. Leasing saves you about $5,544. So why are we still having this conversation? Because 36 months is not how long you own a car, or pay for one, or live with one. The average American keeps a financed car for 8.4 years. The average new lessee signs a new lease the day the old one ends. Forever. Those are two completely different financial lives. And once you stretch the math to 10 or 12 years, the picture flips so violently that most lease customers refuse to look at it. Run the numbers. Let's keep this fair. We give John and Carla identical starting points. Then we press play on 12 years of their life and total it up at the end. Meet John, 40 years old, software engineer, $86,000 a year. Married, 2 kids, drives about 14,000 miles per year between his commute and weekend trips. Meet Carla, 32 years old, marketing manager, $84,000 a year. Single, no kids, drives about 13,000 miles per year between her commute and Sunday errands. Same dealership, same Saturday, same gray Toyota Camry XSE, sticker price $34,400. Same trim, same color, same options. Now here's where their stories split. John signs a 60-month auto loan at 6.5% APR with $2,000 down. His total monthly payment lands at $632. He drives off owning a car he will pay off in 5 years. Carla signs a 36-month lease, 12,000 miles per year. $2,000 due at signing, money factor 0.00250, which converts to 6% APR if you multiply. Her monthly payment lands at $448. She drives off knowing she will return the Camry in 3 years. On paper, Carla just won. $184 cheaper every month for 36 months. That is $6,624 she did not spend on her car. If she invested that exact amount in a low-cost index fund earning 7% per year, she would have around $7,600 in 3 years. Hold that number. Most lease versus buy videos stop right here and announce Carla the winner. We are not most videos, so we keep running the clock. Month 37 arrives. Carla returns her Camry to the dealership. Mileage check. She drove 39,000 miles total, 3,000 over her allowance. The lease contract charged 25 cents per mile over, $750 due at lease return. Wear and tear inspection, a scuff on the rear bumper and 1 bald tire. $420, a disposition fee buried on page 9 of the contract. $395, Carla writes a check for $1,565, and she is now standing in a parking lot with no car. Meanwhile, John is in month 37 of his loan, 23 monthly payments left to go. His Camry now has 38,000 miles, resale value around $21,200. Loan balance around $15,000. He owns about $6,200 of equity. Carla owns 0. Here's where the average viewer says, fine, but Carla just goes and gets a new lease. And that is exactly what happens. She drives back into the same Toyota dealership and signs a new, same payment, not anymore. The 2029 Camry's MSRP has climbed to $38,200. Her new payment is $512, $64 more per month than the first lease. $2,000 down again. Carla restarts the cycle. John keeps making payments. Different game, different finish line. Let's keep this fair. Year 4 arrives. John pays off his Camry in month 60. The very last $632 payment leaves his account. Then nothing again. For the next 7 years, he drives that paid-off Camry. Carla, she is mid-cycle on lease number 2, then lease number 3, then lease number 4. The math from this point forward stops being close. It becomes a slaughter. Here's what nobody tells you about the 12-year window. We are going to total every single dollar both John and Carla spend on transportation between year 1, not just monthly payments, every dollar, down payments, lease end fees, maintenance, insurance differences, taxes. We use the same insurance rates for both. We use the same gas prices. We make Carla and John drive the same number of miles. Then we add it up. John spends $2,000 at signing, then $38,000 on monthly payments over 5 years, then 0 on payments for 7 years. Maintenance and repairs across 12 years on a paid-off Camry runs about $6,800. Total, $46,800. Carla signs 4 leases in 12 years. Down payments stack to $8,000. Monthly payments total around $65,400 across 4 cycles. Mileage and wear fees across 4 returns, $6,200. Acquisition fees across 4 leases, $2,700. Total, $82,300. The difference between the two, $35,500. Run the numbers. That is the cost of choosing leasing over buying for 1 human, 1 Camry, 12 years. And we have not even touched what happens when John sells his car at year 12. A 12-year-old paid-off Camry still sells for around $6,000. So John's true cost lands closer to $40,800. Carla's net stays at $82,000. The gap is now $41,200. Most people watching this just bought 10 years of groceries. That is the real number. That is what is never in the dealership pamphlet. Most people focus on the monthly payment and skip the contract. The contract is where the bleeding hides. Mileage is the biggest one. The average American drives just over 13,000 miles a year. Most lease contracts default to 10,000 or 12,000. The salesman will tell you you can upgrade to 15,000 for just a small bump. That small bump is real. Adding 3,000 miles per year to your lease adds roughly 20 to across 36 months, that is $700 to $1,400. You either pay that up front or you eat the overage at lease return. And here is the trap nobody warns you about. The dealer charges 25 cents per mile after lease end. But if you pre-purchase those same miles at signing, they cost about 12 cents per mile. Same miles, half the price. The salesman who handed you a coffee in the showroom did not mention this. He is allowed to not mention this. The Federal Reserve confirmed it in their official leasing consumer brochure. Excess mileage charges are a legitimate cost the consumer agrees to in writing. Translation, they got you to sign. So you returned a Camry with 39,000 miles. 3,000 over, $750. Carla just paid 40 cents more per mile than she had to. Multiply that across 4 leases over 12 years, and that mileage mistake alone cost her $3,000. The car was already gone. The fees stayed. Here's what your dealer hopes you never Google. The money factor. On every lease contract, there is a tiny decimal number, usually written as 0.00 something. That number is the lease world's interest rate, disguised. To convert it to a real APR, so a money factor of 0.00250 equals 6% APR. Easy math, but you have to actually do it. Most people never do. Carla's money factor on her first lease was 0.0025, 6% APR. Sounds fine, but here is the part the salesman left out. Toyota set the base money factor on that Camry at 0.0010. Equivalent to 2.4% APR. The dealer marked it up to 0.0025. They kept the spread. That markup added $36 per month to Carla's payment. Across 36 months, the dealer pocketed $1,296 in pure interest spread profit. Carla never saw the line item. She did not ask. She did not even know to ask. Auto financing dealers are not required by federal law to disclose. They are only required to disclose the APR equivalent on a loan, not on a lease. 2 different rule sets, same dealer. The next time anyone hands you a lease quote, ask one question. What is the buy rate money factor from the manufacturer? Then ask, what is the money factor you are charging me? If those 2 numbers are different, the difference is profit you are signing away. Most people walk out of the dealership having paid the markup 4 out of 5 times. Run the numbers. 2 fees frame every single lease. The acquisition fee at the start. The disposition fee at the end. Acquisition fees on a typical 2026 Camry lease run around $600. Disposition fees on the same Camry run around $395. Together, $1,090 per lease cycle. Pure paperwork money. The car has not moved. The keys have not been handed over. You pay these for the privilege of being a lease customer. Carla signed 4 lease cycles in 12 years, 4 acquisitions, 4 dispositions, total bookend fees across her transportation life, $4,360. John paid 0 in bookend fees. He had a title fee at car number 1. That was it. Here's what most people miss. The disposition fee is waived if you sign another lease. So Toyota baits you into your next Toyota. Stay loyal, save the $400. Switch brands, pay the $400. That is not customer service. That is a leash, the $400 leash, and it works. Industry data shows that over 60% of lease customers sign their next lease with the same brand. Loyalty is engineered. Numbers are designed. Pay the $400 or stay in the system. Most people stay. Most people lease for one reason that nobody admits out loud. It feels good to drive a new car every 3 years. That is a psychological need, not a financial decision. The 2026 model has a bigger screen, a softer steering wheel, a new lane keep feature. Every 3 years, your dopamine spikes when you sit down. Buyers do not get that. John drives the same Camry for 12 years. Year 6, that car feels old. Year 9, that car feels embarrassing in his coworker's parking lot. Year 12, that car feels like a relic. He has to make peace with that. Most people cannot. That is the actual lease customer profile. It is not the person who calculated total cost. It is the person who could not stomach 12. Status, newness, the smell, the feature creep. The neighbor's lease pulls in and yours is 2 model years behind. That is what you are paying $41,000 to avoid. Here is the math the lease industry runs on. Drivers are willing to pay $3,000 to $4,000 per year. That math is rational only if the alternative is real misery. For most drivers, it is not misery. It is just an older car. The Camry will still get John to work, still pass inspection, still keep his kids safe. The only thing that changes is the photograph he posts to social media. That photograph costs $41,000. Run the numbers. Most people do not. Here's what nobody tells you about car equity. A leased car builds 0. A financed car builds slowly. A paid-off car is pure equity. At year 3, John's Camry is worth around $21,200 and his loan balance is around $15,000. At year 3, John's Camry is worth around $21,200. His loan balance sits around $15,000. Net equity, $6,200. Net equity, $17,000. At year 12, his Camry is worth around $6,000. Net equity, $6,000. The whole time, Carla's lease equity reads 0. 3 years in, 0. 6 years in, 0. 12 years in, 0. She does not own her car. She is renting it. Renting from Toyota Financial Services. Just like renting an apartment, you pay forever and own nothing at the end. The wealth building difference is enormous. If John takes that $6,000 equity at year 12 and rolls it into the down payment on his next car, his next monthly payment drops by $90. Carla rolls nothing. She walks into her 5th lease cycle starting from 0 again. The wealth difference compounds across one financial lifetime of 40 years. That compounding is the difference between retiring with a paid-off house and a parking space, and retiring with a paid-off house and a 6-figure bank account. Same income, same job, different car decision repeated for 40 years. Most people never connect those dots. Let's keep this fair. Leasing is not always the wrong choice. There are 3 specific situations where leasing genuinely wins. First, business owners who can write off lease payments as a business expense. If you can deduct the entire monthly payment from your taxable income, the after-tax cost of leasing drops dramatically. A $600 lease at a 30% tax bracket effectively costs $420 after tax. Second, drivers who genuinely need a car only for short windows. Someone who knows they are relocating in 2 years. Someone who will switch from sedan to truck because leasing matches a known short horizon. Buying a car you will only keep 2 years means eating a Third, drivers leasing fully electric vehicles where federal tax credits flow through the leasing company. Those federal credits lower the lease payment directly every single month. In 2026, the federal $7,500 EV credit only fully applies through leases for many models. Buying that same EV outright kicks the customer out of the credit. So the lease wins by accident, not design. Outside those three situations, leasing is a payment habit dressed up as a strategy. If you do not own a business, do not have a known short horizon, and are not leasing an EV for the credit, you are subsidizing the dealership's profit margin. You pay for the privilege of newness. Run the numbers. Most people fit none of the three categories. Most people still lease. That is the gap between math and behavior. Some lease defenders point to sales tax savings as the reason leasing wins. Here's how that argument works. In most states, when you buy a car, you pay sales tax on the entire purchase price upfront. $34,400 Camry, 6% sales tax. $2,064 in tax. When you lease, in many states, you only pay tax on the monthly payment. So Carla pays around $27 per month in tax across 36 months. That is a tax bill of $972 instead of $2,064. Tax savings, $1,092. Sounds great until you remember she leases 4 times. 4 tax bills of $972 each. Total leasing tax, $3,888. John's total tax, paid once, total John tax, $2,064. The lease customer pays more total tax across the 12-year window, not less. The illusion of tax savings is real on lease 1. It evaporates on lease 2. Most lease salesmen will quote you the tax savings on lease 1, and the federal data is public. The math is simple. The misdirection is profitable. Here's a number almost no comparison video includes. Insurance. Leased cars carry mandatory gap coverage. Comprehensive and collision are not optional, even if the car is fully paid for in cash equivalent of payments. Lessors require it. Lessees pay it. The average insurance premium on a leased 2026 Camry runs about 1. The average insurance premium on a financed 2026 Camry runs about 120. After the loan is paid off, John can downgrade to liability only at around $55 a month. Carla cannot. She is locked into full coverage forever. Insurance differential across 12 years works out to about. That stacks on top of the $41,000 we already counted. The new gap, $44,000. The contract you signed does not just charge you the lease payment. It locks you into a higher monthly insurance bill for the rest of the lease cycle. Forever. Most people never adjust for this. Their insurance app on their phone shows them their monthly premium. They never compare it to what they would pay on a paid-off car. The savings, sitting on the table, ignored. Lease wear and tear inspections are designed to find money. 3 years ago, Carla returned her first Camry. The inspector noticed a scuff on the rear bumper. $82. A small chip in the windshield, even with insurance covering replacement. $60. One bald tire. $280. The carpet on the driver's side had a coffee stain. $120. Total wear and tear bill on lease 1, $542. The lease contract defines normal wear and tear in a 15-page addendum. Page 11, paragraph 4, subsection C, defines a scuff. A scuff is anything longer than a credit card. Most consumers cannot tell you what the credit card rule is, much less measure their bumper. The dealership can. They will. They are the ones who decide if it gets charged. Across 4 lease cycles, Carla paid about $2,400 in wear and tear inspections. John paid 0. He scuffed his bumper in year 4. He decided not to fix it. The Camry kept driving. The bumper kept looking scuffed. He saved the money. The lease industry calls these charges normal. The buyer calls them optional. Here's the twist almost no one talks about. The lease versus buy debate misses the third option, the option most Americans actually choose without realizing it. The serial trader, the driver who buys a car on a 6-year loan, then trades it in at year 3, rolls the negative equity into a new loan, and starts over. About 24% of new car buyers in 2026 are upside down on their trade-in. They owe more on their old car than the dealer is willing to give them for it. They sign a new loan that includes the old loan's leftover balance. They are now financing a car they no longer own inside the loan for a car they just bought. The interest stacks, the principal balloons. By trade 3, the average serial trader is $12,000 to $15,000 underwater. Over a 12-year window, that driver spends nearly $93,000 on cars and ends up owning a $6,000 trade-in. That is worse than the lease customer, substantially worse. The serial trader is the silent disaster of the auto industry. They feel like a buyer. The dealer treats them like an annuity. The salesman calls them a customer for life. The lease customer at least walks away clean at year 3. The serial trader walks away owing on cars they no longer have. Run the numbers. There are not 2 choices in this market. There are three, and the worst one is the one that feels most like winning. Buying a new car, trading it, buying again, trading again. Most people watching this video right now have been on that exact treadmill. They did not lease. They thought that made them safe. The dealer was happy to disagree. Here's the rule. If you cannot keep your car for at least 6 years from the date of purchase, do not buy. Lease. If you can keep it 12, buy and hold. There is no middle option that wins. The middle option is the most profitable choice for the dealership. And here is the line that nobody on YouTube will tell you. The car you drive is not a financial asset. It is a depreciation contract. The only question is who you signed it with, yourself by financing and holding, the dealership by leasing, or both by serial trading. Choose one. Do not pretend there is a fourth. And if you are wondering, what about the equity rich, the subprime trapped, the trade-in cycle people, that is a completely different conversation we will run in another video. But for now, the next time someone tells you leasing is the smart play, ask them one question. How long do you plan to keep your transportation expense in your life? If the answer is forever, the math is buying and holding. If the answer is 2 years, the math is leasing. Anything in between is just a dealership making money off your indecision. The car decision is not a status decision. It is not a personality decision. It is a $50,000 spreadsheet. Treat it that way. This video does not exist to tell you what to drive. It exists to show you what the contract says when you flip past page 9. Most people do not read past page 2. Toyota Financial Services knows that. So does Honda, so does Ford, so does every captive lender on every dealership floor in America. Your monthly payment is not a number they pulled out of thin air. It is engineered against your willingness to ask questions. Ask questions. We break down the hidden math behind the financial decisions you face every day. Make the decision that matches your reality, not someone else's sales pitch.